30. Pete Najarian, though, I got to tell you, I'm coming to you right away, and I'm coming to you on Disney because the commentary that you give today, to me, is the most interesting thing that I've heard today. Can you hear me, Pete?
I can, yes.
Okay, I'm sorry. Somebody was talking to my ear. I don't know what was going on. You say that they're obviously doing everything great, but if I was holding it, I would sell it. Speaking of Disney, they crushed it.
Yeah.
They crushed it. Why would you sell it?
And I say this. Well, and I say this as a former holder, Scott, who wrote it up there really nicely. It went, obviously, I'm going all the way back towards 100. It got up towards 170, time to get out. Now I look at this stock, and I think that they did. They delivered. There's absolutely no question about that. But let's not forget, everybody's so excited about streaming, and that's exactly what they should be focusing on. And that's been a big portion of what really has gotten the excitement levels to where it is. It's also why you're looking at a PE for Disney that we've never, ever seen before for Disney. So I think that's something that you have to keep in the back of your mind. Also, it was the slowest quarter since they launched into the streaming business. So, you know, I know the numbers are great. I get it. I acknowledge that. I'm nobody's fool when it comes to that. But I will say this. It's starting to slow down. And that is something that I think people should be a little bit wary of, maybe worry a little bit. And I think that this stock is probably a buy, but I don't think it's a buy until you get something well below 170.
Okay.
And let's be honest. This is a stock that was 203 back in March, Scott. And then we backed off. And then here it is once again pushing into these 180s. But I still think that there's room to the downside. I think you can enter Disney a lot cheaper than you would right now.
Okay. So let's take that, Kevin O'Leary, and look at the calls on the street today. Bank of America, buy. UBS, buy. Atlantic Equities, overweight. Goldman Sachs, buy. Wells, overweight. Guggenheim, buy. Barclays, overweight. Morgan Stanley, overweight. Evercore, outperform. Cowen, market, perform. And Needham, a hold. And then you get to MoffettNathanson today, which reiterates their hold. $185 is their price target. They have some of the same concerns, Kevin, that Pete does. They question whether Disney deserves to keep a premium valuation. They admit the quarter was amazing. They love the news from the theme parks, and even the digital subscribers exceeded their own expectations. They just don't think they can keep that up. And they say, therefore, Disney cannot keep that premium multiple. What do you say, Kevin O'Leary? You own it.
I do own it, and I disagree, and I'll tell you why. Here's some positives that are built into that print that the street really hasn't focused on too much. We don't talk about ESPN anymore, but it's become part of the premium package along with Hulu and Disney Plus itself. And so when the criticism on Disney and why you would sell here would be around ARPU. In other words, all the excitement, as John pointed out, came from the fact that they actually executed well on becoming, let's call them the second biggest streamer in the U.S. But they don't get anywhere near $9.75 revenue per user. They're like at $4 because all of their growth is happening in places like India, where it's 50 cents a user. So if you're going to stay long, as I am, I'm going to make the assumption that the executional skills that started with Iger on this whole journey have now been passed to his predecessor, who actually delivered a really good quarter. And so you can check the box on new execution skills on the new team. They're delivering. So I don't have the Iger hangover issue anymore. Yeah, he's still around, but the new team is delivering. So now my question to the new team, which they got plenty of, was, how are you going to build ARPU? How are you going to get to compete with Netflix, where they're making $9 plus $10 even, when you're at $4 and change? And their answer was, and this is where you got to make your decision as an investor, we're investing in expanding our share. You get in cheap into Disney, even in their premium ESPN Hulu bundle, and just let us stew that for a while. Give us an Amazon-like vibe. Let us grow without the necessary profits that we could have had until we establish ourselves as a dominant or right beside Netflix. Then we pull the lever on price increases. I'm buying into that story. I'm staying long. This thing's a 5% weighting for me now. And look, I'm saying I believe you that you'll pull the lever, and within the next, let's call it 2 years, you're going to increase that ARPU.
Okay, so you're saying even if, let's say, MoffettNathanson is right in terms of maybe they're going to max out on subs, or saturation is a problem, or however you want to characterize it, they'll be able to raise the prices so that's going to take care of any concerns they have. The parks are going to continue to kill it. So that 50 forward PE, Kevin, is completely justifiable. Is that what we're saying?
Exact.
Did I make my case on Money Court or what?
You just did. But if you don't believe that, you got to be like John. You got to trim, you got to sell down, you got to exit it or just option it. But if you believe they can pull the lever, Pete, then you just pull the lever and you ramp it up. And I think you got to buy into that.
Jason Snipe, you own it too. Which side of the story are you buying in on today? I mean, they crushed it, right?
They did.
Chapek deserves all the credit in the world. They absolutely knocked the cover off the ball. The question is, do they deserve the multiple that the stock is trading at? Can they maintain it to justify where it is now?
For sure. So absolutely, Scott. They killed it. The print was fantastic. It's an expensive stock, and it's a new position for us. We bought in a couple of months ago. We didn't try and chase it last year. Last year was an explosive year. But what I will say to Kev's point on the management team, they've done a phenomenal job. I think from the beginning of the pandemic, they've been on offense in terms of restructuring and expense management. So for us, I think there's upside from here. Even the subs growth, I know some of it is low margin overseas, but I think they've executed very well. I think there's upside from here. Profitability on parks and themes and products, impressive print. And I still think they can grow, and they will from here.
Shannon, you own it as well.
I find the conversations about, the cost of subs very interesting, being a holder of Netflix as well. And I don't disagree with Kevin. I think that there will be more focus, but not right now. I think what we're missing here is the equation on why you owned Disney before they were a streaming juggernaut. For their brand, for their content, and for their park revenue. If you think about free cash flow and what's going to be needed to continue to fund the Disney Plus expansion, you want to see them raising prices at parks, which they're doing. Reservations have not been negatively impacted thus far based on the Delta variant. The global brand and the experience and the quality, the extraordinary customer experience that Disney delivers in their parks and now is going to be able to deliver digitally to your home is something that is worth an expanded multiple. And I think that if you're buying this stock and you're looking out over the next couple of years, you're thinking about capital allocation. You're thinking about what do they do from a buyback and dividend perspective, because that free cash flow component is going to continue to grow. And so I know everybody's excited about streaming. I am too. I love content. But I think we go back to why you would have owned Disney prior to the pandemic, and all of that thesis is still absolutely intact, if not strengthening, as people realize how much they missed having those real life experiences.